Hey guys, welcome back. In the last video, we spoke about who moves the markets, the different instruments we can trade, trading sessions, and leverage. Now, before we actually start reading candlesticks, there are two basic things you need to understand. First, how we place a trade, and second, how we choose a chart and time frame. Let's start with the order types. Okay, whenever we take a trade, we need to tell the broker how we want to enter, right? So, for that, we mainly use three types of orders: market order, limit order, and stop order. Let's understand them with a simple example. So, market order. Oh, shit. Okay. Oh no. Wait. Okay. Where did I go? Oh my god. Yeah. Market orders. First is the market order. Suppose a stock is currently trading around 500 rupees and I want to buy it immediately. I place an order. Here I'm basically telling the broker, buy it for me at the best available price right now. Now, I definitely get it at exactly 500. Not always, but yeah, sometimes. I may get it at like 500.1, 500.2, or even slightly higher if the market is moving quickly. So a market order gives priority to execution, not to the exact price. I'm saying that entering the trade is more important to me than getting one specific price. Now, limit orders. Let's say the price, let's say the same stock is trading at 500, but I don't want to buy it at 500. I only want to buy it if it comes down to 490. In that case, I can place a buy limit order at 490. If price comes to 490 and my order gets mismatched, or if it gets, let's hope it gets matched here, I'll enter the trade. But there is one small catch here. What if the price only comes down to 491 and then moves up? My order won't be executed. So with a limit order, I can control the price, but I cannot guarantee that I'll get into the trade. That's the main difference. A market order gives me much better chance of entering the trade, but the exact price can change. A limit order gives me control over the price, but the order may never get filled. Now, if we come to stop orders, a stop order becomes active only when price reaches a particular trigger level. For example, suppose a stock is trading at 500 and there is a resistance at 510. I don't want to buy while it is below that resistance. I only want to enter if price crosses 510, so I can place a buy stop order above 510. Once price reaches that level, the order becomes active. Stop orders can be used for entries, and they're also commonly used for stop losses. But remember, the trigger price is not always the exact execution price. If the market moves very quickly, your order may get executed a little higher or lower. This difference is called slippage. This even happens in news. While like high latency news is going on. And this is important before placing any order. Know where you're wrong. Don't only think where should I enter. Also ask yourself, like, if the market goes against me, where am I going out? Every entry needs an invalidation level. In simple words, that's the point where your trade idea is no longer valid. So market orders, limit orders, or stop order The order type may change, but the risk must always be planned. Okay, so yeah. Now let's continue to charts and time frames. When you first open a trading platform, like honestly, it can look a little confusing. There are different charts types and so many time frames: 1 minute, 5 minute, 15 minute, 1 hour, daily, weekly. So, which one should we use? Before answering that, let's quickly look at the chart types. Okay, so line charts. I don't have a tool. Huh? Okay, yeah, it is here. I mean, bro. Okay, I need to get used to this. Yeah, line charts. And yeah, for the sibling, I just go okay. Yeah, line charts. A line chart is a simple one, simplest one. It normally connects the closing price and gives us a clean view of the overall direction. Like, see, what you see here is line charts. This is line chart. Okay, if I want to remove this, what do I do? Okay, I'm sorry, I'm just texting it out so that it will be useful next time. So, yeah, okay. It's useful when I only want to see whether the price is generally moving upward or downward or sideways. It is mainly used for watching the trend. But the line chart hides a lot of information. It doesn't clearly show what happened between the opening and the closing of each period. Okay. That's why most price action traders prefer candlestick charts. Yes, here, candlestick charts. Even we, while analyzing, we use this candlestick charts. It looks like this. If you have a thing installed on your laptop or your phone or something else, you will see something like this when you first start. A candlestick gives us four options like open, high, low, close. We are going to study that all four in the next module or next part. For now, just understand that a candlestick shows us much more information than a simple line chart. Now, coming to time frames. A time frame tells us how much time one candle represents. On a 5 minute chart, each candle shows 5 minutes of every price moment. Imagine this is a 5 minute chart. So, every candle is 5 minutes. This is 5 minutes. This is 5 minutes. I'm just giving an example. This is not a proper diagram. I'm really sorry. But yeah. On a hour chart, each candle represents 1 hour. One complete hour. So, on an hour chart, this is 1 hour. This is 1 hour. This is 1 hour. And on a daily chart, one candle represents daily. So yeah, whatever time frame it is. So if it is monthly, it is monthly, monthly, monthly. It is daily, 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 monthly, weekly, 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 weekly. Yeah. So I like to use time frames for different purposes. First, I use high time frames to understand direction. For example, I might check the daily or 1 hour chart to see whether the market is generally moving up, moving down, or staying inside a range. Then I move to lower time frame to find the location or my entry point or point of interest. Let's take a simple example. Suppose the daily chart of Nifty is showing a clear uptrend. I don't immediately like buy just because the daily trend is up. I can move to 15-minute chart and wait for the price to pull back into an important area or a discount area or a support area. Then I look for an entry signal. So the higher time frame gives me the better picture and the lower time frame helps me to plan the actual trade. But don't open every single time frame. Some beginners check the daily time frame, then the 4 hour, 1 hour, 30 minute, 50 minute, 5 minute, 1 minute, even seconds literally. Some people One chart looks bullish, another looks bearish, and finally they become completely confused. Choose a simple hierarchy. For example, daily for the overall direction, 1 hour for important location, and 15 minutes for entry. This is what I do. This is what my strategy is, literally. My whole strategy. Okay, sorry. Again. Okay, I become hyperactive sometimes, so just. So the important thing is that every time frame should have a clear job, okay? So don't keep changing time frames just to find one that agrees with trade you already want to take. Okay, let's just move on to the next slide. I don't know, bro, I'm explaining too much, I guess. Okay, so yeah, I can still move with this, right? So yeah. Okay, so we have completed the market foundation section until now. Let's quickly check what we understood so far. We learned that price is created through the interaction between buyers and sellers. So yeah, I've written these notes on my book. I'll study and then explain. So don't think like I'm this good at explaining. I mean, no one is. But yeah, I make points. I make simple points, and then I teach. So we understood why companies issue shares, and those shares are later traded in the secondary market. We looked at the different participants, retail traders, institutions, market makers, and algorithms. We also covered different instructions, trading sessions, leverage, and slippage. And in this video, we learned about market, limit, and stop orders, along with chart and time frames. Before moving forward, I want to make a small checklist. Write down these things. Which market am I planning to trade? What time will I trade? Which higher time frame will I use for direction? Which lower time frame will I use for direction or entry? Entry. Higher time frame for direction and lower time frame for entry. And how much am I prepared to risk on one trade? Okay, yeah. See plan risk review. Yeah. The process shown here is simple. See plan risk and review. First, see what the market is doing. Then make a plan. Decide your risk before entering. And after the trade is finished, review what you did. Take review. That review is important. Even if the trade made money, a profitable trade can still be a bad trade if you break your rules, and losing a trade can still be a good trade if you followed the plan properly. So yeah, that completes our market foundation module. Don't worry if some of these topics still feels new. Once we start looking at actual candles and charts, they'll make much more sense. In this video, in the next video, we are starting candlestick language. We'll understand the open, high, low, close of a candle and what the candle is actually telling us about, like if buyers and sellers. Go through your notes once, make the small checklist which I said above or before, and I'll see you in the next video. Thank you.